The deep dive is back, and today we're tackling a company that feels, less like a traditional business and more like this sprawling, ambitious empire.
Yeah, an empire built on what? 4 different foundations? Cannabis, beverage.
Exactly. Tilray Brands, TLRY, they operate right at the nexus of cannabis, beverage, wellness, and global distribution.
It's one of the most complex balance sheets we've analyzed recently, and our source material is pretty comprehensive.
Right.
We have their recently released Q2 fiscal year 2023 result.
Right. That's for the period ending November 30, 2025.
And we have the immediate aftermath in the analyst community, including a very notable target price reduction.
So our mission today is to really cut through that complexity. Tilray touts its diversified strategy as this unprecedented platform, but we need to unpack whether this wide reach is actually delivering stable value.
Or if they're just, suffering from having too many irons and too many different, very volatile fires.
Yeah.
To set the stage, we're talking about a global lifestyle consumer products company, headquartered in both Leamington, Ontario, and New York.
So they're everywhere.
Pretty much. Their platform is enormous, supporting over 40 brands in more than 20 countries. We're talking North America, Europe, Australia, Latin America.
And crucially, when we look at their financials, they break their performance down into 4 distinct segments.
Right. Those are cannabis, which covers medical and adult use. Then beverage, so all their craft beer and spirits acquisitions.
Okay.
Distribution, which is their pharmaceutical distribution arm, mostly in Germany. And finally, wellness, focusing on nutritional products. And each segment, it tells a very different story.
Okay. Let's unpack this and start with the headline numbers for Q2 FY 2026. Looking at the top line, the results look respectable, but certainly not explosive.
That's the most diplomatic way to put it. Respectable but stagnant. Net revenue reached about $217.5 million for the quarter.
Which is only a modest 3.1% increase compared to last year.
Exactly. And on the profitability front, adjusted EBITDA came in at $8.4 million.
It is important to stress, though, that while 3.1% growth isn't exciting, those figures did, generally align with or even slightly beat what analysts were expecting.
That's true. Haywood Capital Markets, for example, had projected about $214 million in revenue and $7.4 million in adjusted EBITDA. So they hit the mark where it counted for the street.
They did, but this is where the conversation turns from maybe stability to concern. The profitability quality took a hit.
A big hit. The company-wide adjusted gross margin fell to 26.4%, down from almost 30% just a year prior. When your revenue is barely growing and your profitability is shrinking, you have a pressure point.
Here's where it gets really interesting for me. What was the primary driver of that 3-point drop in margin? Was it an across-the-board failure, or did one segment just pull the average down dramatically?
It was almost entirely due to a revenue mix shift, and specifically the distribution segment. If you look at the figures, distribution revenue soared 26% year over year, hitting $85.3 million. That's huge volume growth. But, and this is the key, that segment operates on a wafer-thin gross margin of just 13%.
Wait, I have to stop you there. Why is a company that is trying to prove its long-term profitability strategically leaning so heavily into a segment distribution that actively drags down its overall profitability profile?
That's a great question, and I think it speaks to their strategic hedging. The distribution segment, mainly in Germany, it acts as this foundational, high-volume, low-volatility revenue stream.
So it's safe.
It's safe. It provides currency and scale, which helps offset some of the, inherent unpredictability of the global cannabis market. It's volume over margin, providing a necessary ballast, even if it looks ugly on the consolidated gross margin line.
Okay, so stability via volume, even if it costs profitability. Let's look at their core business, cannabis, because that segment actually showed a positive margin trend, which contrasts sharply with the overall corporate average.
Yes, that's the silver lining here. Net cannabis revenue grew 2.9% to $67.5 million. This growth was fueled by strong international sales, think Europe and Australia, and some modest Canadian adult use volumes.
But the margin story there is excellent.
It is. Cannabis gross margin increased to 39%, up from 35% in the prior period.
And that margin expansion is a direct result of a strategic pivot we saw this quarter. They deliberately channeled inventory away from the highly saturated, low-margin Canadian wholesale market.
Right.
That wholesale revenue declined by a massive 80% this quarter. because they chose to redirect that product to higher-margin international medical markets.
That decision is exactly what management means when they talk about operational efficiency. They are maximizing the value of every single cultivated gram. Now, we need to talk about the segment facing the most pain: beverage and alcohol.
Oh, yeah. The integration headache.
That's the one.
Absolutely. Revenue here declined substantially, down 20.6% year over year to $50.1 million. And the margin compression was just brutal.
Brutal is the right word. Gross margin in the beverage segment dropped from over 42% a year ago all the way down to 31.4%. That's a massive loss of high-value profitability.
And what's going on there?
It just speaks to the ongoing challenges they face integrating all those craft beer acquisitions, coupled with, general softness and competition in the broader craft beer market. They're dealing with inventory bloat, falling demand for some older brands, and just the difficulty of merging all these different supply chains.
So we have this massive pressure on gross margins, driven by distribution volume and the beverage struggles, yet their adjusted EBITDA still hit expectations. That suggests an extremely effective countermeasure on the cost side. What was that?
It was aggressive cost containment and specifically a huge non-cash mitigation factor. Total operating expenses fell substantially, about $23.7 million lower in the quarter. But the key driver, the big line item that offset that margin pressure, was an 81% reduction in amortization expenses.
That sounds impressive. But for you who might not follow the intricacies of an income statement, what exactly is amortization, and why did it drop so much?
So amortization is the accounting process of spreading out the cost of intangible assets. Things like goodwill, brand names, customer lists they acquired during their big acquisition spree.
So in the beverage and older cannabis markets.
Exactly. The 81% reduction follows massive impairment charges they took in the prior fiscal year, where they effectively decided that those intangible assets were worth significantly less than they paid for them.
In other words, they cleaned house on the balance sheet last year, wrote down the value of those assets, and now they don't have to carry that huge amortization expense every quarter. It's a one-time benefit from past accounting moves, not a sustainable operational efficiency gain.
Precisely. That cost reduction acted as a powerful temporary shield, absorbing the margin pressure from distribution and beverage and allowing them to meet their EBITDA guidance. But analysts know that lever is largely pulled. Future cost savings have to come from operations, not accounting adjustments.
And that leads us perfectly into the analyst perspective. We have this mixed bag. Stable EBITDA, thanks to non-recurring cost cuts, high-quality international cannabis growth, and serious headwinds in beverages. How did the street react?
This is where the story turns bearish. Haywood Capital Markets maintained their hold rating on January 9th, 2026, but they slashed the target price from $18 all the way down to $10.50.
Wow.
That is a massive cut. It signals a profound shift in how they value the company's future.
A drop of almost 42% in their valuation target is huge. You don't do that if you still believe in the immediate growth story. Why the dramatic reduction when Tilray actually hit its consensus numbers?
The cut reflects fading enthusiasm around a single massive catalyst: U.S. federal cannabis reform. Analysts are basically telling us that the potential upside from regulatory change is now seen as being further away or less certain than they previously hoped. Haywood explicitly reduced their valuation multiple to account for this uncertainty.
Let's define that for the listener. They reduced their valuation multiple from 2.5 times enterprise value to revenue down to just 1.4 times on fiscal 2027 estimates. What does that multiple compression fundamentally tell us about investor faith?
It's the market valuing reality over optionality. A 2.5x multiple suggests investors were willing to pay $2.50 for every dollar of future revenue because they believed a massive event like U.S. legalization was just around the corner.
Right.
By cutting it to 1.4x, analysts are saying, we no longer trust that explosive growth. We are valuing Tilray based on its current mixed performance, not its hopeful future. They are paying a huge discount to potential now.
That provides excellent context. Shifting now to the company's foundation, the balance sheet, it tells a completely different story, one of fundamental resilience that really contrasts with that stock market volatility.
The balance sheet is Tilray's anchor. Their debt-to-equity ratio is low, clocking in at 16.2% as of November 30th. That's a substantial reduction from where they stood 5 years ago, and total debt is manageable at around $250 million.
And liquidity looks excellent.
It does. Short-term assets at over $729 million comfortably exceed both short-term and long-term liabilities. But for a company that's still burning cash, the single most important metric is its staying power, its cash runway.
And what does that runway look like?
This is the crucial insight for you, the long-term observer. Tilray has substantial cash and marketable securities, about $291.6 million. Based on their current free cash flow, that gives them a cash runway for more than 3 years.
More than 3 years.
In this highly volatile, capital-intensive sector, that kind of stability buys management immense strategic flexibility. They can afford to wait out the U.S. regulatory process, and they can afford these temporary margin dips as they restructure.
That security gives them breathing room to execute, which brings us to the operational changes. We should also quickly note the 1-for-10 reverse stock split implemented in early December 2025, which retroactively adjusted all the share data.
Right. That move was necessary. When a stock price drifts too low, it risks delisting and, it discourages institutional investment. The reverse split raised the per-share price to make the stock look more appealing to large funds and ensure compliance.
Let's use that breathing room to discuss the long-term strategic initiatives they are pulling, focusing first on Project 420. This is management's cleanup plan for the troubled beverage segment.
Project 420 is designed to deliver $33 million in total annual savings. And this isn't just budget trimming, this is a fundamental portfolio restructuring.
How does that play out?
2 main ways. First, SKU optimization, meaning they are ruthlessly eliminating lower margin or slower growth products.
So cutting stuff that isn't selling well.
Basically, think about all those regional craft beers they acquired. If a line isn't pulling its weight, they are cutting it. Management admits this causes an immediate, temporary reduction in revenue, but the goal is to focus all resources on the profitable, faster-growing brands and hopefully accelerate margin growth in future quarters.
So they're trading immediate revenue for better long-term profitability, a strategic choice that's often difficult to execute.
Exactly. Second, they are optimizing their production footprint and eliminating redundancies. We see the real cost of this cleanup in the financials, with $4.6 million in restructuring charges related to Project 420 in just the first 6 months. They are physically consolidating operations, which generates costs now but will streamline production later.
Flipping back to cannabis, we already noted they're redirecting inventory to international medical markets. And this highlights just a substantial difference in regulatory pricing power.
That's right. International markets, which are often medical and highly regulated, allow for significantly higher prices and margins compared to the fragmented, hyper-competitive Canadian adult use market.
And the numbers back that up.
Absolutely. The strategic choice to accept an 80% decline in low-margin Canadian wholesale revenue this quarter just shows how lucrative those international sales must be in comparison.
And of course, the biggest piece of optionality they are holding onto is the United States market. Haywood believes Tilray's long-term value is tied directly to international cannabis and U.S. beverage exposure.
The whole investment thesis really relies on U.S. regulatory evolution. The potential U.S. federal cannabis rescheduling, moving it from Schedule 1 to Schedule 3, is the key event. If that happens, it opens the door for a much more credible medical cannabis framework.
And Tilray has a plan for that, right?
Yes, they absolutely do. They are ready to leverage their global compliance, manufacturing, and scientific infrastructure, which they have built up over years of operating in these tightly regulated global medical markets, to launch a planned U.S. medical cannabis platform in 2026, assuming rescheduling happens.
But the regulatory environment, especially for their innovative beverage division, is still a moving target, particularly concerning hemp-derived Delta-9, or HDD9.
HDD9 is a fascinating area of innovation. These are beverages that use the psychoactive component, Delta-9, but it's legally derived from hemp rather than marijuana,
which lets them sell it in some states without cannabis regulation.
Exactly. Tilray is developing products here, but new federal legislation was enacted that currently bans their production or sale starting in November 2026.
So their beverage innovation strategy is racing against a ticking clock, hoping that broader cannabis rescheduling might supersede that HDD9 ban and allow continued sales. It's a high-stakes bet on political factors.
And even their wellness segment, which is stable, is pursuing these value-added innovations like high-protein super seeds and high-ball clean energy drinks. Across all 4 segments, you see a management team focused on efficiency and innovation, preparing for a future that may or may not include U.S. federal reform.
So what does this all mean when we synthesize the Q2 results? Tilray shows clear financial stability, backed by that massive 3-year-plus cash runway and strong operational discipline, evidenced by the high-margin international cannabis growth and the execution of Project 420.
It proves their diversification strategy shields them from total disaster in any single market, but it also demonstrates just how difficult it is to achieve cohesive, explosive organic growth across the entire portfolio.
Hmm.
The analysts captured this tension perfectly. They are choosing certainty, the balance sheet strength, over the potential for high growth, which is why that valuation multiple shrunk so drastically.
Tilray is currently a stable, efficient waiting game. They have the time and the capital to position themselves for a better future, but they desperately need that operational efficiency to generate organic growth now that their amortization reduction lever has been pulled.
Execution of Project 420 and their ability to sustain high margins in the international cannabis business. Those will be the critical metrics to watch, regardless of what happens in Washington, D.C.
Okay, a final provocative thought for you to mull over. Tilray has recently transitioned several of its real property assets, their massive facilities and farms, to a self-insurance model to cut down on premium costs. They have hundreds of millions in capital assets globally, $193 million in the U.S., $253 million in Canada, $98 million in EAA.
Right.
Considering they now bear the financial risk entirely themselves, what would be the true material, unplanned cost? Not just financial, but operational. If a major loss event, like a devastating fire or a catastrophic crop failure, were to strike one of their core Canadian or European production facilities, this cost management strategy, while saving cash now, exposes them to substantial unplanned capital requirements and could severely disrupt their supply chain for months, potentially negating years of cost savings. That operational risk profile is a heady trade-off for short-term cost relief.